Markets rarely break at the moment of maximum fear. They tend to break when confidence is still high and concentration is extreme. What we are seeing right now is not simply volatility. It is structural tension building beneath the surface. When the S&P 500 carries more than one-third exposure to technology and less than 2% to mining, that is not just a statistic. It is a capital concentration imbalance. And when rotation begins from growth leadership into materials and mining, that is not a headline, it is a sequencing signal. Our framework does not start with predictions, it starts with mechanisms. This rally has extended for many years with only shallow interruptions. In long cycles like that, liquidity and positioning matter more than narratives. When liquidity momentum slows and risk appetite cools, valuation compression can occur even without a formal recession. That is how a market can appear stable at the index level while internal pressure rises. The discussion around a potential triple top is less important than what it represents. Repeated attempts to push higher without sustained follow-through often signal exhaustion in marginal buyers. At the same time, mining and materials have begun to outperform on a relative basis. That suggests capital is rotating towards sectors with different duration sensitivity and different policy exposure. This is how late Phase 1 transitions toward Phase 2 in our sequencing model. As of February 2026, we would assign roughly 60% probability that Phase 2 compression pressure continues building into June 2026. We assign approximately 30% probability that Phase 1 conditions briefly reassert with another push higher before deeper rotation sets in. And we assign about 10% probability that Phase 3 breakdown dynamics accelerate earlier than expected through the second half of 2026. These are not forecasts. They are conditional distributions based on liquidity, credit, and breadth. Gold and silver fit into this sequence through a different transmission channel. Central bank accumulation, elevated global uncertainty, and fiscal expansion narratives support gold as a structural hedge. Silver adds industrial sensitivity and therefore carries higher volatility. Mining equities provide operational leverage to metal prices, but they also remain equities. In a true liquidity squeeze, they can decline before policy response restores momentum. If you find value in this kind of probability-based sequencing, consider subscribing. The benefit is not more noise. It is a structured way to track phase pressure shifts, liquidity signals, and invalidation points, so you can interpret volatility through a framework rather than through emotion. What would confirm deeper compression? Sustained deterioration in equity breadth, widening credit spreads, and long-term yields refusing to decline even as growth expectations soften. What would invalidate the compression thesis? A renewed expansion in liquidity momentum, improving participation beyond mega-cap concentration, and stable credit conditions through the next earnings cycle. This discussion is for educational purposes and reflects our analytical framework, not investment advice. Our focus remains on signals over stories, sequencing over timing, and optionality over certainty. When concentration, liquidity, and rotation align, markets do not need a dramatic catalyst. The structure itself becomes the catalyst.